Good evening and welcome to tonight's webinar where we look at ASX investment opportunities in review for the 13th of September. The advice provided in this evening's presentation is general advice only. Investor Signals provides a broking account service where we establish a broking account in your name and I act as the advisor. I tend to focus on ASX top 20 and top 50 shares as well as ASX listed ETFs. If you are looking for exposure to international shares, I can also incorporate advice around US stocks, and my focus in the US is the Dow Jones 30 and the S&P 100. If you'd like to know more about our broking account service, please give me a call on 1300 614 002. The products that Investor Signals provides is focused around our research, which is a subscription service, a brokerage account, or a managed fund. And again, if you'd like to know more, please give me a call or visit the website. The technology that I'm using tonight is the Investor Signals member area. You can subscribe to it for $1,320 for the year. And if you're joining us as part of your 30-day free trial and you'd like further tuition on how to use the technology, don't hesitate to call on that 1300 614 002. Starting off this evening with a look at the major indices, and we'll just have a quick look at the Nasdaq, the S&P and the XJO. Now, the reason why I'm drawing your attention to this is the US equity markets have obviously been in a long-term uptrend. Any sell-offs been shallow, that we haven't seen much greater than sort of 2 to 3% correction in over a year. We look at what's happening in the market at the moment, and I just highlight that we're seeing this pattern again where the technology sector's broken below the moving average. And if we look at what's driving this, obviously we've seen a strong rally in the FANG stocks, and we're now starting to see a little bit of profit taking. Whether you can really point to interest rates moving a little higher in the US as the catalyst, whether it's a little bit of weakening sort of sentiment or risk-off sentiment generally, as we're starting to see some signs of patchy or softer economic data come through in the US from elevated levels, mind you. Or just profit taking after. But it's worth, when you think about the corrections that have occurred across the market, obviously in commodities you've seen big corrections in iron ore, we've seen corrections in lumber prices, so there are pockets of the market where the corrections have, if you think about iron ore down over 40%, so we're mindful that there's some adjustment going on throughout the market. The risk to the technology area is more interest rate driven. The rates still remain relatively low, although they've pushed up a little bit off their lows a few months ago. The S&P 500, so similar pattern here. We've seen quarterly earnings at the end of June meet the market expectations, which is the way I like to look at it, is the average earnings of all S&P 500 companies delivered $50 of earnings for the quarter, or if we annualize that, $200 annualized. So what we don't want to see is the September quarter deliver substantially less than that $50. We did see some of the big companies warn that the forward outlook for earnings is not going to be as strong. Is the market ready for softer earnings and at the same time that the Fed begins tapering, which is a reference to them reducing their bond buying program? Now, when they quantitative easing, when they're printing bonds and buying their own bonds, that money tends to find its way into equity markets via the banks, which creates added demand for equities. So if that quantitative easing is wound back, it's just less demand on the buy side of the equity market. So we're mindful that there's those two factors that may come together around the same time, around that sort of October period, and we just need to be mindful of that. So we continue to watch this from a technical standpoint and just highlight that it is below that moving average. Looking at our local market, again, below the moving average, we see a slight lower low pattern through here, and I don't think this is a reason to say don't be involved in the equity market, but we've just taken it, or I've taken this as an opportunity to increase the cash holdings in the portfolio, trim profits on some of the stocks, not get out of the positions entirely, but reduce the position sizing, and really just create more liquidity, that if we are to see a pullback in the market, then the money's there in portfolios to take advantage of that. Looking at the stocks that we like at the moment, so last week I went through the ASX 100. Tonight I'll just do a bit of a skim around a couple of the features in the software, look at some of the stocks, and we won't go into the full detail of all 100 companies. But what I wanted to do to start this evening is click on watch list here, come down, point out that we've added a few new watch lists around ETFs, and I'll have a look at those towards the end of tonight's recording. A reminder, up the top here, you've got the ASX All ETF, so every ETF listed on the ASX. ASX sector indexes have now been added, so that gives you your GICS codes. And the main changes, as I mentioned, was the ETFs added in here. This section here, which is your recent blog posts and your recent ASX signals, just as a reminder, the recent blog post captures the last 30 days of stocks that have been tagged on the blog, and recent signals captures the last 7 days of stocks that have gone through the scanning engine and maybe under buy or sell conditions. So if you want to refresh sort of on opportunities there outside the main indexes, you would look at the ASX. Or another way of finding opportunities outside of sort of the top 20 or top 50, which is where I tend to focus my efforts, is looking at the Asx Small Ordinaries. So if you were interested in that, you could simply click on that list, get the percentage gains to the top, organize it in buy order over here on the right, so you're looking at the best performing stock under buy signal, and you can start by clicking on that symbol and toggling through all those charts there. Again, that's capturing the small ordinaries. What I wanted to do is begin looking at the blog post, so let's have a look at what I've tagged in the last 30 days on the blog. I get the percentage gains to the top, organise it in buy order, and we start with Northern Star. Now, Northern Star, or gold stocks in general, had a good day today. I do still maintain that Northern Star's oversold. It is our preferred gold exposure, and we're sticking with Northern Star and Gold Road Resources as our two preferred gold stocks. Zip, I've just commented on this again around trying to understand whether Zip is really next in line for a takeover. We've seen Square buy Afterpay, and then we've seen recently in the US, sorry, it slipped my mind, one of the big US technology companies have made a takeover for one of the Japanese buy now, pay later companies. So there's consolidation happening in the sector. Zip is just a opportunity. It's relatively high risk, but something, just for you to have a think about if you're looking for a potential growth opportunity for your portfolio. Woodside Petroleum, I like this. I still think this is cheap when you consider where LNG prices are and oil prices. As we've discussed in previous weeks, I get some comfort that BHP's not sold their assets for cash. They've taken a scrip position in Woodside Petroleum. There may be a little bit of overhang where BHP shareholders that get Woodside shares don't want to hold that energy exposure, and that may be weighing on the share price, but I suspect that if anything, the stock will rally as we get closer to the deal, and probably most of the selling would be done ahead of time. But so yes, Woodside I like, and we hold that in portfolios. Link Administration, disappointed in the recent earnings result, but I do think this is well positioned, and we've continued to add to Link. And you may have also picked up from the high conviction portfolio that we've added PEXA as a technology exposure now on the recent pullback. Cube continues to be a holding in our top 50 portfolio, but we did take profit in it as a way of building up that cash reserve. So we've taken profit in the high conviction portfolio, but maintaining it in the top 50. Gold Road Resources, I continue to like this along with Northern Star. I think there's a position for that in portfolios. Reece I haven't added yet, but it's certainly on the radar. The expectation is for Reece to grow earnings around 10% per annum, but it is expensive. I think when I last looked at this, it was trading up from memory around 30 odd times earnings. So if you are looking at Reece, just keep the position size relatively small, or at least maybe 50% of what you would normally do, and think about adding to it if we were to see a further weakness. But I do like Reece as a business, and it has been growing earnings at a good rate, and the expectation is for that to continue. Horizon has been recently added into the model portfolio. It shifted from sell signals into buy signals. It's pretty hard to get excited about the fundamentals here with Horizon. At best, the earnings are for relatively flat earnings outlook. But history tends to tell us that if we stick with these algorithm signals, we could be looking at the beginning of a new uptrend developing. What we would like to see is the price action to take out that $4.15 high, and really sort of ongoing evidence of that uptrend developing. So if you're looking for a new position in your portfolio, you could add a small amount of AZJ, and then over the next coming months, if we were to see further buy signals, you could start to build that position size up. Fortescue has been in the model for quite some time, as we've looked at previously. Back in 2019, it switched from sell conditions into buy, so at around $7. We've had subsequent buy signals, and here we are again back at around $17.50, $18. So certainly, if you don't own Fortescue, you could think about adding it. We've seen pullbacks across all the iron ore plays, so you just need to be mindful of how much your overall exposure is. Do you need to be overweight BHP, Fortescue, Mineral Resources, the OZR ETF? Probably not. So what you may take a concentrated view to maybe BHP and Fortescue, or you may even look at that OZR ETF, which gives you, and I put on the blog the weightings that you're getting in the OZR, which predominantly is BHP and Rio as the highest weighted stocks. But Fortescue down at these levels, I think a buy, and there's room for that in portfolios. BlueScope Steel, we certainly like this. If we look at the history here, it switched from sell conditions into buy conditions at around that $15 level. It's now rallied up to $25 and pulled back. If you don't already hold this, you might be a bit more patient and just wait for a slightly deeper pullback. The most recent buy signal was there at around $19.50, and we're well ahead of that at the moment, so you might just want to be patient if you don't already hold that. The OZR, this is the ETF, as I mentioned, that I flagged on the blog. It is under buy conditions. If you go back through the blog by clicking on the news tab, you can backtrack to when I posted about this, and it includes a screenshot of the weightings in this ETF. So that's just simply a way of getting exposure to Australian resources, with BHP Rio being the majority exposure in that. Wesfarmers, so the correction at $65, Wes was getting a little expensive. Fair value is probably somewhere around that $55 as support. In a low interest rate environment, if you were to look out into sort of 12 months, the next 12 months, obviously the 6 months to December is going to be disrupted from the COVID shutdowns. But if we looked out 12 months, do we get a more normalised trading condition, in which case Wesfarmers should find support at $55 thereabouts. So if you don't hold that, you can think about adding that to your portfolio. Altium I like simply because Autodesk in the US saw value in this business at $36.50 thereabouts. Autodesk are one of the top technology companies in America, NASDAQ 100 technology companies. So for them to see value here at $36.50 and the Altium board to reject the offer, I think you can reach the conclusion that the downside risks are relatively low there. So we've started adding some exposure to Altium. It's under algorithm buy conditions. So one in the technology space we need to have a think about. BHP, again, we like this. There's room to add this to portfolios, but don't go overweight. We've seen buy signals across a number of these resource stocks, so just think about your overall allocations. Macquarie Group has been the better performing stock, so the thesis there of being long Macquarie over the banks has been right. Macquarie's delivered better earnings growth. But that rally in the share price was really that the earnings were not going to fall as much as the market had expected, and that created that bullish response or the share price appreciation. And what that means overall is over the next 12 months, Macquarie's earnings should be pretty close to what they were over the previous 12 months, whereas the market were expecting those to fall. Macquarie tends to be fairly conservative on their guidance. Would I chase it at these levels? Probably not. Just be patient, and if we see a pullback, would look to add to that position. But we continue to like Macquarie. CUV rallied off the better earnings result. Food as an ETF. This is a beta shares. So again, what we're doing is toggling through what's been covered on the blog. IHD. I'm posted this today. This is the Ishares Dividend Opportunities ETF, and I included the screenshot of what you're getting exposure to by buying this. It's a pretty defensive basket of shares that I'm pretty comfortable with. The dividend yield's attractive, so if you're looking for something there in the ETF market, that may be a fit for your portfolio. Australian Pharmaceuticals under buy signals, need to do a little more analysis on that. Coles, we've started adding that into portfolios on the pullback. Rio under buy conditions. JB Hi-Fi, maybe back at around $40. I'd get excited about that. Maybe it's starting to come onto the radar a little more than it had been. Fuel ETF, my preference is still Woodside Petroleum, but again, just drawing your attention to a managed fund there around the energy space. Treasury Wines we like, but really moved a fair way from the original signal at $10 to $12.30 there. Collins Food, I've taken profit on that, so we're no longer exposed to that. Cochlear, we've added that to portfolios, doing well. Mineral Resources, the more I look at this, I think the outlook looks attractive, but again, you just don't want to be too overweight. The iron ore names. Bega, sticking with this following the earnings result. I thought the earnings result looked okay there. Exposure into Asia, still sticking with this, the IAA. So we've cut down on the Asia technology exposure and tilted more of the exposure towards this IAA. So probably going to be a fairly slow turn in this, but around that 110 should be support there. Cleanaway in the trading portfolios, I've taken profit on this just because it's getting a little expensive from a PE standpoint. I'd probably expect this to more track sideways now over the next 6 months, but the long-term thematic is still certainly bullish there for Cleanaway. Car sales, this is under sell conditions at the moment, and just highlighting that the earnings result delivered above expectation. I expect we'll see this pull back maybe down to around $21, $22 and a shift back to buy signal, and I'd look to add that in. Ansell looking for a slightly deeper pullback, which I spoke about in the prior weeks, and from a value standpoint maybe back at around $32. I'll draw your attention to that on the blog. CIMIC is a counter trend trade. You'd know from following the recordings that my preference here is to actually buy call options in CIMIC, so it limits the downside risk to whatever you're outlaying for the call option. And we're looking for CIMIC to deliver better earnings results over the next over the next 6 months. Cure ETF, US Biotech, I think there's still a place for that in portfolios. So that was just toggling through what's been on the blog. What I wanted to do tonight is click on the model portfolio, and we're just going to review what's in the top 50 portfolios. So again, following the steps here, we click on model portfolio, click on the drop down here, go down to ASX 50. As a reminder, any of these models that you want to get a separate email on a notification as to stocks that are added or removed, just make sure that envelope's green rather than grey. As a reminder, we've added these new ETFs in here, and when I finish the top 50, we'll just spend a little bit of time just to show you what's changed there. So the ASX 50, the way I like to arrange this is get the least number of days to the top. and we'll toggle through these and have a look at what's been added and how it's performed since it's been added. So Coles Group had been in the model previously. It was removed. It's now been added back in at around this $17 level. So if you don't hold that, that's one for you to start building a position in. As is AZJ. Keep the position size small in AZJ, but there's room for that in portfolios. Rio, the correction that we've had from 140 down to 100, we're seeing this in the portfolio, and I think whether you gain BHP, Rio, just keep the position sizes so you don't end up too overweight iron ore. ANZ is in the model portfolio for the top 50, so we're comfortable with a small exposure there. Westpac's in the model, it's performing okay. BHP's now in the model as well, so we've seen BHP and Rio added. South 32's performed very well since being added to the model. Santos now under buy conditions. We've seen the Santos oil search deal progress on to the next level, where I think the oil search directors have recommended it. It goes to vote, I think maybe November, but it's looking like that deal's now going to proceed. So Santos in portfolios, we're comfortable with that. Macquarie's certainly been the better performing financial stock since being added at around that 145, now trading 175. Treasury Wines has performed well. It's up roughly 20% since being added to the model. Woodside Petroleum, I think there's value here, so if you don't already own it, we're increasing the weighting there to Woodside Petroleum in our portfolios. Commonwealth Bank under buy conditions, it's performed well since being added at around $80. Woolworths still in the model portfolio, up from around 34 when it was added, now trading around 39. Zero under buy conditions, so it switched from sell to buy conditions there. It's been in the model, trading up from around 120 to 150. Goodman Group has been our preference within that property play, and the two from the ASX 50, you would just follow the model, but also you may have exposure to that SLF, which is the property ETF. Property ETF. Goodman Group switched from sell conditions into buy conditions here at around 16, now pushing up to 22. It is getting expensive though. Mirvac under buy conditions, it's done well since being added. GPT's performed well. Lendlease is a longer term recovery opportunity, but that's in the model and tracking just below the original entry. Stocklands has performed well since it's been added. Cochlear are doing very well since it's been added, as is Aristocrat, one of the better performing stocks in the top 50 model. Computershare switched from sell conditions into buy signals here in September last year at $11.80, now trading $16. Wesfarmers, as I mentioned, in the model portfolio, and so is Fortescue. Sydney Airports is in the model portfolio. We've seen the increased takeover offer at $8.75, and the board recommend that, so that deal should now go ahead. And Northern Star in the top 50 model, and back to Coles. So just to recap that, so looking at the top 50 model portfolio, looking days held and just going through the performance of them. So Coles has been in there for 4 days, Horizon 12 days, Rio 31 days. If we have a look at the best performing stock, you've got Northern Star, Sydney Airports, Fortescue, Aristocrat. So you could arrange these in a number of ways. Percent change, so there's a few stocks there that you're able to pick up below the original entry price, and there's another group of stocks there that have been in there for quite some time and done very well. If we have a look at that in these new ETF models, so historically we've had the ASX All ETF, which this is a model portfolio, as the name would suggest, of all the ETFs listed on the ASX. So that's been in there for a while, and you may be familiar with that. The other one that's been in there for a while is the Ishares, so ASX Ishares, which is a model portfolio of only Shares Etf, which is BlackRock, and that's performed extremely well. So the two most popular portfolios that I manage for brokerage accounts for clients is exposure to the ASX 50 and exposure to the ASX iShares. A combination of those two strategies has performed extremely well. So looking at the iShares, so you can go through that in your own time and have a look which ones have been added there recently. And then here's what's new. So we've now added the Van Eck ETFs. So again, if we go to days held, you can toggle through these. These are just ETFs in the model portfolio, meaning that they're under buy conditions, and it's by a product provider, which is by VanEck. If we have a look at the other providers there, ETFS, so we've just taken the major providers, and you can see here that the holdings in this portfolio, the percentage gain and the number of days. A popular ETF provider is the Beta Shares ETF. This gives you a bit more of a broad exposure to less index related, so you're getting more sectors and specialized sector allocations through here, and you can again organize it by days held and have a look through what funds have recently been added into that. And one you may be more familiar with, which is Vanguard, which is a low-cost index manager, and you can have a look at the ETFs that have recently been added. So again, if you want to follow any of those, just make sure the envelope's on green rather than grey, and at around 7 a.m. you'll get a email, which is any of these lists that you've turned that envelope on green, you'll get that notice all grouped together as one email around that 7-8 a.m. in the morning. Often I cover some of these changes on the blog, but not always, so if you're wanting to follow a specific portfolio, make sure those notices are on. If you're too busy and you want to open a brokerage account and have me look after it for you, then again the most popular portfolios that clients are invested in is the ASX 50 and the ASX 100. Being the advisor for the portfolio, my focus is on managing the position sizes and adjusting, so taking profit and adjusting the size of the positions to enhance the returns and ensure that cash is available to take advantage of any pullback in the market. So if you'd like to know more about the broking account service, please give me a call on 1300 614 002. Thank you for listening in, and next week